Emergency credit access for low-FICO consumers, products, costs, and exit strategies. Scope and purpose. This report synthesizes factual guidance for consumers with impaired credit who seek rapid unsecured funding between $5,000 and $50,000, emphasizing product structures, eligibility signals, funding timelines, pricing risks, and prudent exit planning to avoid debt escalation. It distills the source material into discrete, action-oriented topics suitable for legal economic analysis and consumer protection planning. Footnote. This section defines the report's objective and frames the analysis for time-sensitive, subprime unsecured credit decisions. Market context and use case. Typical applicants face high APR revolving balances, cash flow gaps, or emergency obligations. Short-term loans are sought as bridge financing and not as durable solutions. Elevated pricing reflects lender risk modeling for low FICO profiles. Absent concurrent income expansion or cost reduction, repeated borrowing increases default risk and the probability of insolvency or bankruptcy. Footnote. This section explains why borrowers pursue quick cash and why reliance without structural change is financially hazardous. Product 1. Prosper Unsecured Installment Loan. Prosper offers unsecured installment loans generally from $2,000 to $50,000. With typical minimum FICO around 600 and occasional approvals reported near 560, underwriting remains multi-factor and pricing increases materially at lower scores. Funding can occur quickly relative to traditional channels. Proceeds are fixed term with amortizing payments and prepayment flexibility depending on contract. Footnote. This section identifies core terms and risk pricing characteristics of a mainstream marketplace installment product. Product 2. Upstart Unsecured Installment Loan. Upstart offers approximately $1,000 to $50,000. Using broader underwriting signals, better pricing requires stronger credit, while approvals at very low scores are possible at higher cost. Illustrative rates in favorable cases can be near low teens APR, but subprime tiers price higher. Funding speed is designed for rapid cash needs with standard amortization and automated payments. Footnote. This section describes range, underwriting approach, pricing tiers, and funding cadence for a general-purpose installment lender. Product 3. Credit Fresh Revolving Line of Credit. Credit Fresh provides a revolving line reportedly up to $5,000 with fast disbursement, often within 24 to 48 hours. Cost is assessed via per billing cycle charges that can imply high effective APRs, making it suitable, if at all, only for short draws repaid rapidly. Structural features resemble open-end credit and can compound costs if balances persist. Footnote. This section notes the speed versus cost trade-off and elevated effective pricing risk associated with revolving subprime lines. Cost structure and risk. 1. Interest and fees escalate as credit risk rises. 2. Revolving products can generate compounding charges if minimums are paid. 3. Installment loans reduce utilization but add fixed payment obligations. 4. Prepayment reduces total finance charges where allowed. 5. Stacking multiple loans elevates delinquency risk and fee cascades. 6. Any missed payment can trigger penalty pricing and derogatory reporting. Footnote. This section isolates the principal mechanisms through which borrowing costs accelerate for subprime consumers. Operational use guidance. 1. Define a precise dollar need and document purpose. 2. Borrow the minimum amount that resolves the acute gap. 3. Map a 90-day amortization or payoff plan before funding. 4. Consolidate the highest APR revolving debts first when mathematically beneficial. 5. Enable autopay and calendar reminders to prevent delinquency. 6. Avoid simultaneous applications that trigger hard pull clustering. 7. Reserve a fraction of proceeds for emergencies to prevent reborrowing. 8. Prohibit further discretionary card spending until balances decline. 9. Track credit utilization and score changes monthly. 10. Seek forbearance or hardship programs from existing creditors before adding new debt. Footnote. This section converts product facts into procedural steps that mitigate default and fee escalation risk. Income expansion strategy. The source material conditions short-term borrowing on parallel efforts to increase earnings, e.g., secondary income streams, so that fixed obligations become serviceable. Absent incremental income, temporary liquidity generally fails to restore solvency. Proceeds allocated to productive uses must be paired with conservative revenue assumptions and rapid break-even targets. Footnote. This section articulates why pairing borrowing with new income is central to exiting subprime debt cycles. Eligibility and underwriting signals. 1. FICO score bands influence pricing and limits but are not exclusive determinants. 2. Verification typically includes identity, employment, income, and bank account history. 3. Debt-to-income ratios constrain approval and size. 4. Rapid funding depends on prompt document submission and bank connectivity. 5. Early payoff options and fee schedules are contract-specific and should be reviewed pre-signature. Footnote. This section summarizes common underwriting criteria and procedural factors that affect approval and timing. Consumer protection and alternatives. 1. Compare credit union personal loans and employer-sponsored advances. 2. Request hardship or workout plans from current creditors. 3. Evaluate nonprofit credit counseling for structured debt management. 4. Avoid products with opaque fee metrics or rollover incentives. 5. Preserve records of all disclosures, rate tables, and payment histories. Footnote. This section catalogs lower cost or protective pathways that may reduce reliance on high-cost credit.